After launching the company, raising a $1.5 million series or seed round, building up the products, getting into the market, and having an exit all within 3 years, there was definitely a lot of things that I took away as key takeaways. That when I talk to different entrepreneurs about starting their business, really the things that I think are important to think about, so that when that opportunity comes up, you're prepared. So one of the things I always talk about, and the first key takeaway, which is we didn't really fully vet out of the gate, my team and I, the idea of an early exit. And more importantly, I think we didn't really think about what we were trying to get out of this opportunity. We were just excited about an idea. We wanted to do a startup. We quit our jobs and off we went. And I see that a lot in other companies that I help mentor in different startups and different folks. And so one of the key things I always talk about mentors, or as a mentor to entrepreneurs, is what are you trying to get out of this opportunity? And what's interesting to me is that the answers are all over the map. And it's anything from, I'm just so passionate about this idea, I just want it to come true. Or it's, I want to be a billionaire. Or I really want to, I've been doing startups for a while, I want to be the boss. Or, I want to make all the decisions. And all of these things make a huge difference on what you're trying to get out of the opportunity. And my team and I we had some pretty honest conversations early of what we were trying to accomplish and what we wanted to get out of the opportunity. And in some cases, depending on what you're trying to do, an early exit is the worst idea possibly. And so one of the best pieces of advice I can give is that if you don't want to sell your company, don't talk to people about selling your company. It's a huge waste of time. And it will also lead your team and investors down paths of kind of wrong expectations, and really I think can cause some conflict if you even consider these things. There's nothing wrong with not wanting to sell and just continue to build. A lot of really successful companies hit that standpoint. But at the same point, there might be situations where that is the right outcome, or that's what you're looking to do. So I think the number one key takeaway is that before you even go down this path, make sure that's the path you want to go down. Or if it's a path that you and your team and your investors are open to. Because it's a huge time suck to work on an acquisition at any phase of a company. The next key takeaway is, especially in an early stage company, it can be exceptionally dangerous to try and hit product market fit while you're out raising money and trying to sell your company. And if you don't have the bandwidth for that, you're not going to do any one of them probably particularly well, and put all three of them at risk. And so when I worked with my board and advisors early on, another key takeaway that we definitively talked about was, we've got to pick a path. And they really looked to me as the CEO and the key founder of, what's the path that's right for this business? And we've got to pick maybe one, maybe two, but trying to do too much with a thin team, seed companies, a company at a seed stage most likely has just a couple key people. You're really asking those people to put in more than they probably can handle. And in the end, again, everything is at risk. So it kind of goes back to the first key question. It was understand when you want to get out of the opportunity. And the second is then, again, if you don't want to sell your company, don't talk to people about it. You've got to focus on product market fit. You've got to focus on trying to get the resources such as capital or team members you need. And if you're trying to do too much, then again, you're going to fail. The third key takeaway for me was, and again, I think this is a bit more of a personal philosophy, which is, I think most businesses have a natural path, meaning based on the idea, the market, the dynamics that are playing out, the people on your team, the investors that you bring to the table, you are creating a natural path that your business wants to go down. And too often I see entrepreneurs that just beat their head against the wall, just trying to make something that's not there, or trying to force their business down a path that's not going to work. And I think in the end, that's where you end up with just a ton of zombie startups. There's a term that I've heard before, which is a company that basically is dead, that just has not died yet, or is staffed by a team that just has not been willing to give up. And in some cases, someone needs to tell them, hey, it's not happening. You should try something else, pivot, do a new project, take time off, right? Take on an investor, do something different. Another key takeaway for us is that if you really do want an early exit, depending on what your initial goal is, if you just want a quick win, and I think, I've talked to a lot of different entrepreneurs who are looking for it, just want to put something in the market, I want to maximize its value, and I want to get out. Again, if that's your goal, there's nothing wrong with that. But the key to that is don't take too much money. Don't raise too much, and don't raise it from investors that don't have that same philosophy. because there's a number of investors out there who are only investing for the long haul. They want you to be a billion-dollar IPO or bust. And if your strategy is a quick flip, they're not aligned. And I think a lot of first-time entrepreneurs miss that who they take money from and how much they take is going to drastically alter their exit opportunities or their personal outcomes from that opportunity. And so I've seen this before from entrepreneurs that have spent a decade building a business and raised $5, $10+ million or tens of millions of dollars for opportunities and just get stuck in that business. They can't exit. The hurdle that they have to get over to have a positive outcome for investors is just so big that they end up spending years on a business that they've long lost passion for and are just pushing on it. And I think that can be painful. And so again, just understanding if you take too much money, you are forced to have a really big, really large outcome. That may not be a great outcome for your investors or for your team, which again, that can be problematic. You spend a lot of time trying to build that out. So the most important thing I think around an early exit as well, beyond just the philosophy in these things, is really appreciating that an early exit is a strategic exit for the buyer. They're not most likely buying you for revenue or for intellectual property or for what they can do. There's always going to be a player in that strategic company saying, hey, we could just build this. I don't know why we're not building this. So you are filling some strategic need that some person in that buyer says, this team and this company or this idea is going to help us get this, or we can't get that on our own. And you really got to figure that out. But you also got to appreciate that, though I think a good popular saying is startups are bought, they're not sold. I agree that's true, that the best opportunity is one where someone comes to you and they see that, and they say, I want to buy that company. That's obviously the best. But at that point, you are selling. There are tons of different players in that company that you're going to be working with where you're going to have to convince them this is why this fits your strategy. Because in a big strategic acquire, there's always going to be the naysayers. There's always going to be the people that are just indifferent to the idea. There's always going to be the people that have their own pet project that you're competing with, or you're just not as important to them as maybe the main sponsor of the acquisition. So you're going to spend months selling these people. And if you're not good at that, I've had investors and advisors at Balance early on that said, if the CEO and the founding team cannot sell this business at a strategic level, no one's going to be able to do it. And so that's an important piece. You really got to look at yourself or look at the members of your team and say, do we have kind of natural born salespeople that can get up and really speak passionately about where this fits, why it's going to be the best outcome for the buyer, how we're going to solve their problems and really execute against their strategic fit where we think we fit. And so again, really just appreciating that and understanding, big solution selling and strategic selling and the long process and working with all these different players. In my background, I've done strategic selling previously in my career, so I understood the process. But if you're not up for that, then again, it may not be a possibility for you, or you're going to have to be willing to learn something that's actually quite complex and hard on the fly, which is doable, but just increases the complexity and risk of the possibility. So the other thing we had was be patient. These things don't happen overnight. You really have to be patient when you're selling your company. And when we were acquired, the first overtures of acquisition we got from a couple different companies was in the fall of 2012. And we exited 12 months later. And the company that ended up acquiring us, our first introduction to them, first face-to-face meeting we had was in May, late May, and we ended up exiting 4 months later. So which was a quick exit with that company. They still say today, man, that was a really fast process and we just came together quickly and it worked out. It didn't seem like that at the time. It seemed like lots of time just sitting around waiting, agonizing over every email that came through or didn't come through and every word they said, spending 2 times a day talking to, it seemed like every board member and investor and advisor and lawyer and attorney that we had. Just this agonizing and long process that in the end, from an acquisition, was fast. And so you have to be patient. You can't freak out. You can't get too lost in the process. You really just have to continue to manage it and get your sleep, get exercise, keep working on your product, keep your team motivated, keep them focused on the long haul, but again, continue to just incrementally work the process. The other thing that's important, especially in a strategic exit, is that since you're not selling for revenue, since you're not selling for IP, you're in a very tenuous position. That strategic value that the company that wants to acquire you feels that you have, that's your leverage. And you have to not only maintain that leverage, which somewhat is out of your control. They may find another way to fill that strategic void. They may come up with a more important strategic initiative. You have no idea. So the best thing that you can do is create a sense of urgency, a sense of importance, that you are important and that this is going to go away if they don't do the deal. And the best way to do that is through a competitive process, having multiple people at the table and things like that. I had entrepreneurs that worked strategic exits that only had ever one player at the table, and it just took forever because there's no motivation by the buyer. There's no sense of urgency. There's, hey, this will be their next month just the same as this month, so they get distracted. So the thing that we really did right is we had a number of players at the table, and we were able to not only improve our confidence of, hey, this is the right way to go, and this is the right natural path for this business, and we're going to be able to maximize the outcome. And further, it takes a positive strategic outcome or a positive strategic exit. And if you don't have leverage, it can turn it into a fire sale, just like that. And so if you want to have a positive outcome, you really have to make sure that your business is in a position where it can be patient, it can really try and appeal to multiple players, and that ideally it appeals to them in different ways, especially if it's a strategic value. It can really change the potential outcome monetarily of the deal. Another key takeaway that I had was around, especially for strategic opportunity, a lot of what the acquirer is buying, especially now around acqui-hires or even just whether or not it's an acqui-hire plus technology or things like that. At the heart of a strategic deal, though, is always going to be the team. Even if there is something more of value that's being bought, or if there's more assets than just the team is still the number one thing. It's very much like early stage investing where the team is kind of the number one driver, like I said, around presenting the strategic value. But the group that's buying you, your buyer, is not just buying the vision that you can create, it's really the fact that you were the one to implement it. And so you've got to be prepared to really make that transition. And understanding that in a strategic exit, there's going to be escrows, there's going to be money that's tied up, there's going to be earnouts, there's going to be still motivation for your investors, for you to stay engaged and to execute. And so really making sure that you are able to execute the vision that you outlined to that strategic buyer and saying, hey, this is what we talked about doing, and then having a plan to do it and to continue to motivate your team and to continue to kind of prioritize and try and make that happen as you move forward was key. And so when we went through the acquisition, I put together this is a 100-day plan of how we're going to integrate. We had a negotiated 18-month strategy of what we're trying to accomplish. We had very detailed, this is the role that everybody's going to play. I negotiated everybody's salaries and bonuses and the outcome from the deal, and it was really putting a lot of foresight into this is what the next 2 years are going to look like. And in the end, that's the difference of having an exit that's great for the investors versus an exit that's also great for the investors and great for the acquirer. And I think in the end, you want both. And I think that's just good for your career and for overall the team and their ability to do another deal. You want to be able to tell investors, not only can I be a great entrepreneur, but I can be a great executive as well, and I can execute on those things. So I think this is just a key takeaway in knowing that whatever you sold to that potential buyer, you really got to deliver it, and the importance of that, the value. So as we found that natural path and it became apparent to our team, how I communicated that out to the rest of the investors. So the key is that, it's just is what I call, it's a lot of cycle time. Just it's you in your head cycling through, is this the right thing? And going through the different scenarios. And then I went to a couple key board members and said, hey, I think this is the way to go, and this is why. And it really lets you hone that position, and then you would start to kind of communicate it out. So the nice part about not having a lot of investors, and I had a fairly manageable number of about a dozen or a little bit more than that. So the problem if you have like 20, 30 investors, or especially now with the changes in funding, you can have investors with just a few thousand. People on Angel List who I had, they've never actually met, that have small money. I think the appeal is having a smaller list. It makes it much easier to communicate. Because in the end, you're going to spend a lot of time on the phone with these people. And depending on how the deal is structured, like at the end of the day, the acquirer is going to want to know that every investor signed off on this deal, that it de-risks it for them. So in the end, you've got to convince everybody, even if it's, I was convincing people that had $500,000, $800,000 into the deal, and people that had $10,000 into the deal. And it takes almost as much effort to convince them. So number one, keep your investor list short. The number two is, I think, work with your board members. If you have a good relationship there, a couple key investors, you can kind of hone this, not only your own thinking, but also then this is the message and this is why we did that. So I spent a lot of time on the phone with investors and going through, hey, we looked at this option, we looked at that option, and in the end, this is what I think the best thing for the businesses is. And I think it's important to note, and I took this really seriously, when you take money from other people, right? When you take other people's money to try and pursue your idea, they're along for the ride just as much as you are. And I really tried to look after their best interest and protect their investment. So I spoke to it this way, which was, hey, when you invested, this was the goal, and this is what we found. And what I found is this is the right path, and this is the right outcome, and it's going to be a good thing, and here's why. This is what we should do. And you want them to know that you're doing this from a position of, it's not emotional, you're being thoughtful, you're working hard, you're really kind of looking at all options, and you've come to a logical conclusion. And if you can do that and you've got a good relationship with your investors, and they're not crazy people, hopefully, then they'll agree. Unfortunately, there are some crazy people, and some of the investors that I had saw things differently, and it took a little bit more convincing. But again, if you approach it the right way and you're thoughtful and you present your findings and you don't have too unwieldy of a group of investors, then you can get it over the line. The process of getting players to the table, I don't think there's one silver bullet. I mean, you can work with an investment banker. They potentially could bring people to the table. I think partners and people that you work with already as a business are the easiest targets. For me, it's about finding a natural path in the conversation to bring it up. And that it's an art. It's just one of those things that for whatever reason I seemed quite good at, to be able to try and get people to come up with that idea of, hey, we should buy them on their own in a way that either you prompt that thought in their head by just saying the right thing at the right time or throwing out like, hey, or you could buy us, right? Or, hey, we could partner together and we could feel the strategic value, but that value is going to be harder to do if I'm off working with these guys, just so you know. Or it was a matter of, I'm out raising funds, and before I raise funds, I wanted to see if there's anything more strategic that we could do together. So just trying to find the right language and get it going. I think the other key thing is that finding the right person. Finding someone that's senior enough they could actually pull the trigger and motivate it, and finding their motivations and trying to match that up against. So it's a lot, again, just going back to solution selling and trying to find the right way to get that value proposition across without making it seem too salesy. But it's hard. The key, though, I think, is just having enough really good relationships, spending time with your partners and your vendors, spending time with just networking and trying to build, hey, who's the person in such and such company that would be interested in maybe this value add type of thing. So again, no silver bullet. It's out there working your network and having relationships, spending a ton of time meeting with people and talking about what they're trying to accomplish and how you might be able to help.